Well, hello everyone. I'm Jake5. Today, this is Portfolio Growth, and today we're going to go over the golden circle. As always, this is being recorded. You can view this disclaimer at your leisure once I post the replay. So, how's everyone doing today? I'm doing a lot better today. And as I said, we're going to go through the golden circle today, and we're going to do it this week, and we're going to do it next week as well. And we'll also look at some stocks near the end of the day today during this class. So, with that being said, let's jump right into it. First up, there's your introductions, budgeting, investing mindset. We're going to go through the golden circle, my portfolio, and resources. So there's table content, and don't worry, I will provide everyone with the PowerPoint and the Excel budgeting and the Excel compounding of the golden circle here at the end, so you can all take that with you. And I'm going to make this video free, so once I'm done uploading it, you can show it to your friends and family if you so choose to. It's going to be free for everyone, premium member, not premium member. I'm going to upload it and just send it out to the world, link it on Facebook, give it to anyone you want. It's going to be free. With that being said, let's jump right into it. First of all, who am I? Well, my name's Jake5. I'm married to my wife Sarah of 11 years, and I have 2 kids, soon to be 3. One is 5, Henry, and the other is 3, Jonah. Here's a nice picture on our last trip, and since this picture is taken, I assure you I still have not put on pants, and my kids have gotten a lot bigger. This was taken at Casa de Fruta on our way to Monterey Bay Aquarium, which is a pretty fun trip here. So step 1, we're going to talk about budgeting. And I know budgeting is a little bit boring, but we got to break down into it, and we got to talk about budgeting first. Then we're going to break down that budget, and then we're going to set some goals. So, step 1, what is a budget? A budget is telling your money where to go instead of wondering where it went. That's from Dave Ramsey, which I put Dame Ramsey here. For some reason, I always put Dave and it always changed it back to Dame. I don't know why, but I'll try to fix that when I get up there. But it always changes that, and I do not know why. So, here's some resources. You can see it changed back to Dave over there. If you do not have any budgeting tools, here are some free resources you can use. There's Dave Ramsey's site. The Government of Canada actually has some very good tools for that. There's not OneView. Be careful, they're going to try to sell you on other things, but the OneView is free and it is very excellent. And Microsoft Excel actually has a really good budgeting program here. And this is actually the budgeting program Microsoft Excel has. You can actually just go up, put in a budgeting template, and here it is right here. I will give you this template so you can mess around with it. And you might be saying, well, Jake, this is kind of boring. Well, if we go right down to the bottom of it, there is actually a summary that actually tells you what our monthly income is, our total expenses, how much we can put in savings, what our cash balances are. You can set it up right here. Our income sources. We can fix our little budget here, and we get our monthly saving right here. So it's not really flashy, but budget doesn't have to be flashy. It can be pretty simple here. So we will go over this here in just one moment. Let's get back to it. So all free resources for you to use. Now this is you're going to find pretty interesting. The average U.S. household income makes about $59,000 and 59,000. Yes, Otis. $59,039 a year. That's $4,919 a month. That's $1,229 a week, and that's $30.74 an hour. Now this is the combined household income. So this is 2 people working, making an income. So it's actually gone up. Last time we went over this golden circle, it was only $56,000. So the United States people have gotten a $4,000 raise since the last time we've gone over this golden circle. So pretty good. Now you might be saying, Jake, where are you getting your data from? I get it from the St. Louis Fed, or St. Louis Federal Reserve. There is a link right in the corner to it, and I will provide all data there. You can see that we quite haven't made it back to where we were. Now this is where we last looked at it. You can see this is from 2016, I believe. It says 2015, but it cuts off right on that 16 there. So you can actually see it has gone up. We're not quite there where we were in 2000, but if we go to the next one, you can see it's a little bit more blurry. You can see right there we have gone back up to 59,000. So the United States income is going up. It is higher than it was in 1998, where it kind of peaked and it started going back down. So we are making a little bit more money here in the United States. Now remember, budgeting is really important because the plan is to build a retirement account, and we have to figure out where our money is going, and we have to plug any leaks. And once we have all these leaks plugged, we have money to invest, because first you have to invest in yourself, and you have to actually have money left over every month, and you can't be going on a credit card. You have your bills go higher and higher and higher and higher. It's going to be really hard to invest if you're in debt. So nice little income here. You can see nice little spike up. Now let's go over some budgeting. This is a typical budget of the U.S. household income. I've done a lot of research. This is what most people pay. Rent, mortgage is about $1,000. Electricity is about $140. Gas about $60. Cell phones about $60. Groceries about $900. Car payments about $450. Auto expenses are about $120, and that's anywhere from gas to a little bit of repairs it might need. So that one's a little bit light. Student loans. Most United States citizens are in some form of student loan debt right now. About $50. Credit card, $773. You might be saying that's a lot, and we'll get to that why that's a lot here in a moment. Auto insurance, about $78 per month. Personal care, about $50 a month. Entertainment, about $100. Miscellaneous, about $100. Now you'll see there are some things that I have missed from here. One being I did not put health care on here. Now the reason why I didn't put healthcare on here, because it is very difficult to get an actual average through data what most citizens in the United States pay in healthcare. And this is U.S. medium household income as well. So this could be a family of 4, this can be a family of 3, this can be a family of 5. With that being said, I did not put healthcare on there just because the variables are too high on that. So you're going to be seeing at the end of this budget a little bit more money than you expect taking home, and that's because of healthcare not being included. But you can see all right here, pretty average rent. That's the average rent for a 2-bedroom, 1-bath house in Fresno, about $950. It's gone up a little bit, and that's why I put $1,000. The average new car price is $30,000 with a loan of 67 months. So over 5 years, with a payment about $447. Again, there's some data for it. The average household income credit card debt is $8,448, with an average rate of 17.69. That 17.69 has gone up since the last time we've gone over this PowerPoint in 2016. But you'll be interested to know that debt has kind of held steady. Debt has not really increased since 2016. The only thing that's gone up is credit card interest rates. So really, really interesting to see that in debt. Now, that's the one reason why I have such huge credit card payments right here. It would take, if your plan was to get out of credit card debt, it would take about $773 a month for a year to get out from under that credit card debt. And the whole goal is to have a budget that's healthy near the end of this, so we can invest with the leftover of our paycheck every month to build a retirement, build some type of portfolio for ourselves. So if you're wondering why credit card debt is that high, it's that high because this is what it's going to take to get out of debt in 1 year. Really absurd number. And this is what most Americans are in. Now, some data will say, well, there's more debt in other regions that you're not accounting for, or there's less debt. We're just going to go the average credit card debt for that. This average debt that people are in other out than the car payments here. And the reason why I put Fresno as opposed to other states and other cities is Fresno is a very unique position here in the United States. Fresno is one of the few cities in the United States where renting and buying are pretty close together in price. So the cost to rent an apartment, it's close to buying a house. So pretty close there. So that's why I use Fresno as my data to look at. I also live in Fresno, but I also know the metrics of Fresno, and that's why I used it. So with that being said, those are all your resources, and you will have access to this PowerPoint when it's done, so you can check all these resources for yourself, which is really interesting. You should really look at the credit card debt. It's kind of just leveled off here. Same with auto loans. Auto loans have kind of leveled off here. And if you're an auto investor and you're noticing that auto loans are kind of leveling off, maybe moving a little bit lower, that tells us that car sales are starting to move a little bit lower as well. This is one thing that's very interesting. This is the total consumer owned and securitized debt outstanding. Now this was updated this year. And you can see this is debt that people are in, credit debt. And you may have noticed a trend from the 1950s to current. More and more people are living paycheck to paycheck, and the reason why they're living more paycheck to paycheck is, one, is it's gotten a lot more expensive out in the economy. Two, a lot of people are living outside their means. You can see we had a little bit of a dip right around here. We had a dip around here. And we had a little dip around here. 2007, 2008 collapse. Dot-com bubble pop. And the 80s. Remember what happened in the 80s. So you can see credit card debt is becoming a little bit more and more outstanding here. Interesting. Here's the updated. This is 2016 data. This is 2018 data. Both of these have been updated. One's just a little bit better than the other. And you can see a little bit more the trend smooth out in the little bit updated chart there. Nice little spikes back up. Now, more and more people living in debt here. This is from the Federal Reserve of St. Louis. So this is where I'm getting a lot of my data from. You can actually use the actual FOMC or the Open Market Committee if you so choose. I like the Fed a little bit more. The data is a little bit more streamlined. So what does that leave us? After all that, you come with a total of $3,881 a month in bills. That leaves you about $1,000. This is a generous number. Remember, we did not include health care. At the end of your month, that's what you should have, excluding health care costs and other costs I didn't put in there, from your paycheck. Now this is the average U.S. household income. You can see that over 1/4 is left over. Really interesting. So we take that number, and that's what the number we have to invest with. So say you want to set aside $200 a month. Can we build an investment portfolio with $200? This is where we're going to see a lot of compounding, and this is where our jumping part is right here. We're going to start with $200, and we're going to see, can we build a portfolio on that? Remember, the amount you put in changes your account and rates, and you can retire. So if we're building a retirement account, $50 is going to be a lot slower than $100, which is going to be a lot slower than a $500, which is going to be a lot slower than $1,000. So the more you can put into this, the faster you can reach your goals. But can you do it with $200? Yes, you can. You can do it with $50. You can do it with $5 a month. It's just going to take a little bit more time. Just remember, 50, 100, 500, 1,000. If you can put in $180, it's going to be a lot better than you can put in $50. But the more you put in, the more you throw at it, the faster you're going to compound this rate of return. So remember that. Remember, set goals that maximize your potential but are in the realm of reason. If you're walking away every month with $1,000 at the end of the month, excluding some costs, it's kind of unrealistic for you to set aside $2,000 a month. If you're walking away with $1,000, $100 is realistic. $200 is realistic. $300, you're getting to a little bit high there. But if it's within the realm of reason, it's alright. You need to set these goals to be reasonable and outside the realm of unrealisticness. Put them in the realm of reason. And remember, if you walk away with $1,000 a month, $2,000 is unreasonable. $1,500 a month is unreasonable. $800, you're getting pretty close to the realm of unreasonable. Remember, there is no shortage of money, only a shortage of age of people thinking big enough. You can do this. $50 a month, $10 a month, $5 a month. You can do this. $5 a month, you can go work at Amazon Mechanical Turk. You can do a little bit of surveys every month, and you can find that $5. $1 a day is $30. You can find $1 a day to put away $30 a month. It is reasonable. Now remember, when it comes to debt, no one can serve two masters. Either you will hate the one and love the other, or you will be devoted to the one and despite the other. You cannot serve both God and money. That right there is to tell you that you cannot serve two masters. Either you're chained to your debt and your debt is guiding your life, or you're a master of your debt. That's why it's so important to understand this credit card debt. Understand debt that a lot of people in the United States are in. Right here tells us that a lot of people are servicing their debt. This is the billions of dollars. Almost 400 hundreds of billions of thousands of dollars right there in debt. These people are serviced by their debt. Debt is guiding these people's lives, and when your debt is guiding your life, you're servicing your debt and you can't service yourself. Remember that. So, we have our budget in place. We have money set aside every month. We are out of debt. What are we going to look for? Where do we start? Why bonds? My rules for trading and a penny double. And a penny double is going to show you the power of compounding. In a minute, I'll get to all your questions as well. What are you looking for when you're building an investment portfolio? Are you looking for growth? Are you looking for income? Are you looking to preserve your capital? Are you looking for liquidity? Are you looking for tax relief? These are things you have to ask yourself when building a portfolio. If you're looking for growth, you want to look for some equity. If you're looking for income, maybe you're looking for bonds. Maybe you're looking for municipal bonds. If you're looking for preservation of capital, maybe you're looking for a savings account. Same with liquidity. Maybe you're looking for a money market account. You're looking for something you can pull your money in and out of really quickly but still get a little bit of a return. Are you putting a big pool of money away? Well, maybe you're looking for tax relief. Municipal bonds and federal bonds offer tax incentives. Some of those will make it so you don't have to pay federal or state taxes when you invest in them, municipal bonds. Maybe you're looking at that. All these come with some type of return. You have to ask yourself these questions when you're building your portfolio account. Are you looking for growth? Are you looking for income? So keep that in mind when you're building your portfolio. What are you looking for? The tax relief one I thought was pretty interesting when doing the research. Municipal bonds, federal bonds, state bonds, government bonds. It puts you in different tax brackets. Will change the rate in which you are taxed at by the government when it comes to certain investment products, and so something to look at. So we figured out, hey, we want to do a growth or an income account. We figured out what we want to do. So where do we start from there? How do we pick a stock? How do we pick bonds? Well, the first thing you do is you look at everyday items that you use. Who's my phone carrier? What type of computer do I use? What car do I drive? Who do I bank with? What fuel do I use? What appliances do I have in my house? If your house is full of GE appliances, is it full of Whirlpool? What's your favorite thing to drink other than water? Which water itself is a good thing to look at. Last year, water overtook soda in portable drinking. Something to think about. How old are you? That really factors in. Why should you look at bonds? Why should you look at bank CDs? Maybe you should have a little bit of your portfolio invested in some bank CDs, maybe into bonds. Maybe it's good to diversify. These are all questions you need to ask yourself when building a portfolio. Who's your phone carrier? Do you use AT&T? Do you use Verizon? Do you use Sprint? Do you use T-Mobile? A lot of those companies offer a pretty good dividend. What type of computer do you use? Do you use a Dell? Do you have an NVIDIA GPU graphics processing unit? GPU and graphics processing unit. It's just that. It's just that. What car do you drive? Do you drive a Ford, Toyota, Honda, Tesla? Just go out and look about yourself and look. You can find companies to invest in that are pretty quality companies just by the everyday items that you use. There's a reason why they're everyday items that you use. Fuel. Do you use ExxonMobil? Do you use Sinclair? Do you use Shell? Those are investment companies as well. So these are important questions you ask. Now, I've broken down some of these questions and we're going to look at the portfolio I built from that. Now, why do we choose bonds? Well, bonds help protect against events you can't account for. Some bonds can even outperform dividends with reduced risk. That's why you want to look at bonds. Bonds help you when there's some uncertainty in there. Bonds are relatively safe. Companies can default. Companies can go under. The United States government has never defaulted on its bonds. It is considered one of the safest investment you can make because it's never defaulted. But can the United States government default? Yes, it can. Hopefully it never will. But bonds are a little bit of a hedge against uncertain risk there, and that's why we look at bonds. Bonds are a really nice hedge for uncertainty. Also, age comes into factors when you come into bonds. Can you sustain an account that has high volatility in your profile and you're getting closer and closer to retirement? Or do you want the stability? That's why you look into bonds. Now, we are in a time where the Federal Reserve is raising rates here, and so there is a little uncertainty in bonds. But the yield in bonds is going to be relatively 3 to 5% in the next couple years. Most likely, it's not going to default. It hasn't in the last 100 years. And it's considered a relatively safe investment. So keep that in mind when looking at bonds. The older you get in this retirement fund, the less volatility you want in your account, and typically bonds are where you look at. So that's why we look at bonds. So we've picked out bonds, we picked out a couple stocks we liked, or a couple stocks we have for eyeballing what we want to put in our account. Now we need to build some rules for trading. These are my rules. Remember, they are just my personal rules and should be used as a guideline on what your rules could look like one day, but may differ. It's okay if they do differ. They can be different than my rules. These are my risk tolerance rules, and that yours can be different than mine. My risk tolerance is different than your risk tolerance. These are just a guideline. So let's go look at them. So here's my rules for trading. And remember, it's important to write down your rules for trading. Put it somewhere you can see it every day. You want to have these memorized. First of all, how am I going to protect my capital? Well, first, I'm going to check for earnings and news. I'm going to use covered calls, colored calls, or protected puts for my stocks. I'm going to ask for advice from coaches and mentors for analysis. If I don't understand what's going on, I'm going to research it from people that I have looked at it towards as mentors or coach. I'm going to get asked for help. Remember, we live in a world with over 6 billion people in it. You can ask for help. It's okay. We live in a society that asking for help is sometimes shunned upon. Don't think that way. Ask for help. Seek sage advice from wise advisors. It's okay to do it. You do not have to go on this alone. There's people in here. You're in a community today that will help you. Leverage that insight and intelligence of the people around you to your benefit. It's okay to do it. Number 2, have a plan. Stocks and options can only go 3 ways. They can go up, down, or sideways. They can't go anywhere else from that. Either the market's going to open tomorrow, or it's not. The stock's either going to go up, it's going to go down, or it's going to go sideways. It can't go outside those 3. Have a target price, have an entry price, and have an exit price. Have a price that say, hey, if the stock ever got here, I'd like to buy. If it ever got here, I would like to sell. Have those prices in place. Always check fundamentals and technical analysis beforehand. You don't want to get into a trade and find out, oh, hey, it's billions of dollars in debt and they're closing a majority of their plants tomorrow, if it's a industrial company. You want to know the background of your companies that you're investing in. How long have they been in business? Who runs it? Do you like the CEO? What's its PE ratios? How much debt does it have on books? Does it pay a dividend? When are its earnings? These are things you need to know beforehand before you enter in a stock, or at least for me. Only trade on markets near the open or close. Now, typically I only trade the market close to the opening or close to the close. I don't trade usually I don't trade midday in the market. If you swing trade, that's crazy not to trade the trade only in those 2. Remember, these are just guidelines. Your rules will be different than mine. Again, unsure what to do? Take a walk and review your notes. Say a trade went against you in a way you were not expecting. Do not let emotions guide your trading. Take some time, take a breath, get away from the computer for a moment or 2. Review your notes on why you got into that trade, and give your time to think about it. Do not make rash decisions. Take a breath, relax, It's okay. Do not let your emotions dictate your trading. When your emotions dictate your trading is when you will make a mistake. You have to follow your guidance that you have there. That's why I have that there. When using options, look up the strategy first. If you're going into a iron condor, if you're going into a strangle, a straddle, into earnings, maybe you should research that strategy before you put it on. Don't risk money until you are sure on the strategy you're using. Because when it comes to time to unwind that position, if you research it beforehand, you'll know how to leg out of it. You'll know how to adjust it. But if you just go into it without researching it first, you'll have no idea how to unwind this position, and this position that could be profitable now is costing you a lot of money if you had no idea on how to use it. So we always look up strategies first. Position hedging. I don't trade more than 1/3 of my account on one trade. The reason for that is if that all of a sudden it does that unexpected down move, well, I don't have more than 1/3 of my account on that one trade. I don't get completely wiped out. I'll still have 2/3 on the sidelines for that. I only trade stocks that have a history. I don't trade stocks that just hit the market. I usually don't trade IPOs. I usually like them to have a year or two, or at least a couple months before I trade them. Even if I really, really like the company, I like them to have a couple of earnings histories behind them before I go into it, because that gives me some time to look at the fundamentals and the technicals in the stock. Trading IPOs in a company that just released the market today is not going to have a lot of fundamental analysis behind it. It's going to be really hard to trade those companies. China stocks are still suspect. Remember, I wrote these rules when I almost first started trading. I've adjusted them throughout the years, but these rules have not changed very much. China stocks are still suspect right now. Renren, Youku, Baidu, Sidu. I don't even trade Youku or Renren anymore. I look at Baidu and Sina. Baidu is a little bit more stable, but those are the companies I look at. And there's a couple of different ones that I've looked at over the years. But just understand, China accounting is a little bit wonky here. Sure, it's one of the largest economies on earth. It's the second currently right now. But their accountings are a little bit off. So, because of uncertainty in that, I don't invest there. And two, I usually only trade 2 years or more. Remember, I don't trade IPOs that just hit the market, even if I really, really like the stock. I like at least 2 years that I can look at its history, that I can look at its technicals, its fundamentals for building a investment portfolio. Sorry if I'm still getting a little bit tongue-tied here. So that brings us to a radio contest, and let's actually go look at any questions or comments you might have here, because we have been going 20 minutes here. So let's go look at a couple questions you might have here. Very good. What's good all seeing here. So let's just jump back in here. Now there was a radio contest a long time ago, and one lucky person called in and they won, and they were given 2 options. The first option was $1 million. All they had to do was come pick it up. Or they were given a second option. The second option was every day for 31 days. They were given on the first day a penny that would double every day for the next 31 days. Now the radio contestant said, well, a penny doubling every day couldn't really add to anything, so they picked the $1 million, which was, you still walked away with $1 million, don't get me wrong, but how much money did they walk away from the table? Most people don't understand the power of compounding interest. Albert Einstein himself said that if people understood the power of compounding interest, they would be better off in life. Now that's a mangle of what he actually said, but it's pretty close to what he said. Compounding interest is very powerful. So let's go see how much money she walked off on the table. Well, here it is. This is the power of exponential growth. Why $50 a month in a portfolio account can really add up here. So here's that same penny, doubled every day for 31 days. She would have walked away with $10,737,418.24. She walked away from $9 million, because remember, she got $1 million. Now remember, a penny It's not very much the first day. Second day, it's not very much. Well, it's now 100% gain the next day. Another 100% gain every day. Look at that, 18 cents, 32 cents, 64 cents. It wasn't until day 18 that it really started to add up very quickly here. And you can see $1 on the 8th day, $2 on the 9th day, $5 on the 10th day. And we get to the 18th day here, $1,310 turns into 2,000, turns into 5,000, turns into 10,000, turns into 20,000, turns into 20,000, turns into 41,000. The 25th day turns into 100,000. Look at that, the 27th day. The 28th day, she would have had more money that day than she would have just taken the $1 million right there. The 29th day, the 30th day, and then the 31st day. So never discount the power of compounding returns. Exponential growth. A little bit here, a little bit there really adds up if you monetize it over time. You can see all the math is right there. So the takeaway from that is take the penny, doubling every day. Invest in yourself and you will see growth. Now, you may not see a lot of growth, but after a while that growth will become very exponential very quickly. If we were to change this into percentages, remember this is 100% gain every day. Even if it's just a little bit. So now you have a little brief, you have your stocks, you have your portfolio, you have your rules. So now you go out and you want to compound the circle. Let's go compound the circle. So this is my portfolio and this is my setup. Remember, here's another disclaimer because we're going to go over, this is the setup in 2016 and we're going to have a little bit of changes, a little bit of tweaks to it since then, and I'll show you the tweaks here in a moment. My plan. The plan is to build a portfolio that will grow over time, so I want some growth. To achieve this plan, I'll be using stocks and bonds that pay a dividend and can do covered calls and options on them. So I want there to be optionability in everything I do. I want to have the covered calls add to the income, the growth to these companies I picked. Now, as you know, some of the companies didn't perform very well, and we'll get to adjustments here as well. So, my setup, I have $20,000 to start this plan. Most people don't have $20,000, remember. 50, 100, 500, 1,000. Where you start really determines how quickly you can change how fast your circle will compound. I have a basket of dividend-paying stocks and bonds. My end goal is to make $100,000 a year from covered calls and dividend-paying stocks and bonds. My midterm goal is $33,000. My short-term goal is $11,000. You might be saying, well, Jake, that's a lot. It is, but that's my end goal. That's my midterm goal. Those are my short goals. Remember, we're going to set realistic goals, something that's not outside the realm of reason. So, let's go break it down. To reach $100,000 a year in dividends from stocks that I own, I will need to make $8,333 a month or $33,000 a quarter, which is a lot of dividend paying stocks. So let's break it down a little bit further. Let's have a goal and let's break it down to manageable and reasonable levels. So $33,000 a year. I'd have to make $2,777 a month or $11,000 a quarter, which is still a lot paying dividend stocks. So let's break it down even further. You can break this down as far as you want to go. So here's $11,000. To reach $11,000 a year, I'd have to make $925 a month or $3,702 a quarter. I find this goal to be obtainable. So this will be my starting goal. But you can break it down as much as you need to. Now, I looked at a lot of other people's portfolios to find solid companies with some of the growth. The people that I researched are Warren Buffett, Jim Cramer, Todd Sopnos. I went to Investopia. I went to FinViz to break down the fundamentals of the stock. Emerson Money to break down the fundamentals. I listened to earnings calls. I look at the company's histories. These are companies that I've looked at pretty in depth, and these are the ones that I'm currently looking at. These stocks I like: AT&T, Microsoft, ExxonMobil, GE, Ford, and TLT. You may notice that a lot of these are pretty volatile right now. AT&T just had earnings that weren't spectacular. They're in currently court to get that merger with Time Warner. That doesn't look very well for them, but it pays a pretty good dividend, and it's a utility. Telecoms they usually pay a pretty good dividend, and they are covered callable, so I like it. Microsoft has recently returned to growth. Of the people here today, who uses the PC with Windows on it? Microsoft's a pretty stable company. ExxonMobil, gasoline is being very volatile right now, and it looks like there is going to be return to natural gas. ExxonMobil at one point was the largest company on earth per market cap, and you can't fly a jet on solar and wind power yet. You can't drive a truck on wind power. So the gas and oil industry seems to be doing all right. You can't power a house completely in a city with just having that city be exclusively solar. There are some exceptions to that rule, but natural gas is seen as a viable alternative to coal, and with the United States sitting on top of the largest supply of natural gas here, ExxonMobil, that runs a lot of pipelines and has a lot of natural gas wells, should be all right. GE, we all know GE has a ton of pension risk, and a lot of the old CEO left it in some big distress, but GE makes a lot of products, and a lot of those products are still used today. They make jet turbines. They make a lot of industrial products, and they own a lot of the piping and networking for natural gas as well. Ford, again, I had a Ford truck, so I looked at Ford. It is one of those everyday things that I picked. I had a lot of GE appliances in my house. Pick GE. And then I looked at the 20-year plan, the TLT. TLT pays a monthly dividend, so I looked at that as well. So these are the basic stocks that I looked at. Say you didn't like those? Well, here's a breakdown of a couple more. There's AT&T pays a 48-cent dividend, Microsoft 36, Apple pays a 52. Some of these companies have increased their dividends since the last time I posted up there. ExxonMobil 73, Kraft Food 57, JP Morgan Chase 56 cents, Coca-Cola 35, IBM $1.35, and American Express 29. And you might be saying, well, Jake, I don't like these dividend players either. I know, Otis. I posted a couple more. Here's Johnson & Johnson, Procter & Gamble, Verizon, General Motors, General Electric, Philip Morris, the Altera Group. If you don't like any of these, well, guess what? This is your portfolio. You can build it to how you like it. This is just some stepping off points to look at. Now, I picked stocks that I can also sell covered calls against. The stocks I picked have the ability to sell calls against them and can provide a modest amount of credit while being out of the money. The plan is to sell covered calls every 15 to 20 days if possible. With covered calls, I plan on beating the dividend, but plan on using the dividend as a fallback. So I plan on owning Microsoft and selling a covered call every 15 to 20 days on Microsoft, and hopefully that covered call will outpace the dividend. So I'll be making a nice amount of return, growing the circle a little bit faster doing that. And sure enough, if you go look at it today, right now, I currently have 200 shares of Microsoft that I have 8.15. I have 2 covered calls right here on it. Microsoft pays a dividend of, as of right now looking, 42 cents. One covered call is netting me about $1.22, so it's outpacing the dividend. I sold one covered call and I'm already beating the dividend for that quarter. I sold 2 covered calls. I'm now beating the dividend for the year. Pretty close to that with these 2 covered calls. So pretty happy with how that's performing. And I have if I cannot sell covered calls against it, well, I do like these companies, and these companies do have a dividend. So I'm happy with that as well. If I'm unable to sell covered calls while I wait the 15-20 days, I'll just try again. If I can't sell this covered call cycle, I'll wait another 15-20 days and try again. It's okay to wait. At the end of 3 months, if I didn't sell any calls in which I get a dividend pay, still get the dividend payout. So if I did not have any covered calls sold against these stocks that I do like, I still got the dividend payout on these stocks. So this is what the portfolio I wanted to look like when I originally built this. I plan on buying 100 shares of Microsoft, AT&T, ExxonMobil, and GE. I already own 100 shares of Apple for this. At the time, I did own 100 shares of Apple. I no longer own the shares of Apple. It got a little bit too expensive for the account, and so I adjusted it. This would be the breakdown from that portfolio that I did have when I put this on. So 100 shares of AT&T, I'd make about $192 from the dividend. Microsoft, at the time I did this, would pay about $144 a year from the dividend. ExxonMobil, $292. GE, $44. GE has adjusted since then. They actually pay a reduced dividend now. And Apple, at the time, paid a 52 cents dividend, $200, $8. So that would be about $808. This is not with the compounding numbers as well. Remember, we're going to compound this circle, and every quarter looks different, but just from the year perspective, this is what it looked like. And from compounding from that penny double, that will look significantly different. Now, this is what I've learned from the first time that I started this. AT&T, Ford, Microsoft, and Apple have been difficult to sell covered calls and retain the stock with my purchasing power. Apple kept going up, and when I bought the stock, sold a covered call, I kept getting called away. Now, yes, I could have rolled the call, but that would have monetized it out longer than the 15 to 20 days, and I could have retained the stock, but I was okay taking the gains from the stock from the covered call and the profit from selling that call, and maybe putting my money somewhere else at the time. Not the case for Ford and AT&T. TLT covered calls and monthly dividend have put me 6 months ahead of my current time frame. Because TLT paid a monthly dividend and I was able to sell calls a little bit quicker than that 15 to 20 days, it put me further ahead because I can put that money somewhere else. I also learned that you need to make sure you have some capital ready when you see a stock on your list that is in the lower end of your range. Sure, you can put your money every month, you can put it towards stocks, but say there's a stock you're eyeballing, say AT&T is moving down to that 30 handle, and you've understood that in the last 5 years, every time it's gotten to that 30 level, it's bounced back up, and maybe there's the potential of a move there for AT&T. Always have some capital on the sidelines ready to acquire one of these companies at a discount. You like Microsoft at $80 and it's currently $90, and it's dipped back down all the way down to $80, $78. And wouldn't it be nice to have the ability to purchase it there at the target in which you like it? So it's always wise to have some money. Sure, that money is not really growing for you, but it has the ability to purchase something at a discounted price or where you'd like it at. So always have a little bit of money on the sidelines for it. Don't trade retail unless it's Costco, Walmart, or Target. And even those, you should be careful. Just like Chinese stocks, retail stocks are very precarious. Your Macy's, your Sears, they're in a very bad spot right now. Most likely they're going to be going under in the next couple years. Remember, bonds and equity. Why do you want to have a little bit of bonds in your account? Well, the uncertainty. There's always going to be something in the market that kind of disrupts it. Retail right now, they didn't evolve. Sears and Macy's did not evolve. Now they're going to go the way of the dinosaurs. Of those resale stocks that did evolve, Costco, Walmart, and Target did the painful steps necessary to do so. Target is slowly growing their digital presence. Walmart acquired Blue, and Costco has a digital presence. But those big box retailers like your Macy's, your Sears, your Kmart's, which is owned by Sears, they didn't. And they're going to go under. So remember, that's why you got to look at the fundamentals and technicals in these companies as well. So do not trade retail. Something also interesting is protecting your portfolio from selling covered calls and receiving dividends. You can use that excess capital that you receive, and you can buy a put to protect your positions. You can protect against downside risk, so you can protect for some uncertainty. Right now I use months of TLT's covered call premium dividends to buy two 560-day expiration puts against my 200 shares of Ford at the 10 strike. Now it was like the 967 strike, to be honest, but I bought 500 days of protection on my Ford position using the dividend from TLT and the covered calls from TLT. I bought protection against some downside. 560 days. Let's see where that 560 days currently sitting at. Since I put that on, it's been 300 days with those put protections that I have on Ford. You can see I have 200 shares of Ford right here, and I still have those long puts on. Same with GE. 260 days of protection. I used some of the returns that I made from dividends from covered calls, and I bought protection against downside in the account. And I bought GE at 25. I bought a 23 put, and GE is currently at 14. I bought protection for downside. I used some of the covered call premiums, and I bought protection for downside in Microsoft. You can see right here, 92.95. AT&T. Same thing. I bought protection, and I bought over 500 days of protection for downside risk in the stock. And you can see I bought it at 43. It's currently at 31. I bought it at 35 for protection. I didn't figure this out until a little bit later for GE, or for AT&T, as you can see. But I went and I took some of my gains and I bought protection, and now I don't have to worry about downside for the next 260 days. Over a year is the amount of time that I put on. I put over 580 days. I put over a year of protection. And now I don't have to worry about putting on protection again until this gets close here, and I can set money aside to it, or I can just readjust the position. So it's okay to put on protection on the account. So now that I've ignored chat for a little bit, let's go take a look at chat really quick. Yeah, you'll have access to all of this at the end. I'll post the PowerPoint. All the links are inside the PowerPoint. I'll give you the budgeting for the Excel sheet, and I'll give you the Golden Circle Excel sheet, and we'll be getting to that very quickly here. So you have access to that. Let's see here. 3 months in a quarter, so monthly should be multiplied by 3, not by 4. Well, this is for the there's 4 quarters in a year. Let's get back to where that was. That's why I always come back for questions. There's 4 quarters in a year, so that's why it's times 4. But I understand what you're saying. You have your first quarter, second quarter, third quarter, fourth quarter. And that's why it's times 4. But yes, the dividend is paid out every 3 months, if that's what you're talking about. Or did I put it right here? Maybe he's talking about right here. But anyhow, I appreciate it. I'll fix it. So with that being said, we've gone over protecting your profile. Remember, it's okay to take returns to protect your portfolio. It's okay to do it. You can take that penny doubling every day, and you can say, hey, the markets sometimes are volatile, and I have the ability to protect my position and keep some capital inside when I see these positions that I'd like to get in trading at a discount. Just something you have to think about when building your portfolio. Now, you can adjust every dividend cycle if you like. Say that Ford was not performing well and you wanted to get out of Ford, or GE now has a reduced dividend, you want to get out of GE. Well, you can adjust. There's no reason why you cannot. You have your protection in place. You could adjust GE. Say you wanted to get out of GE. You can. if you so choose. You have the protection. Say your protection is now offering you the ability to get out of that trade and maybe reallocate money somewhere else. You can definitely do that. There's no reason why you can't. Always watch for your outperformers or laggers and adjust. If Ford is not producing the returns you like, you can adjust it. You can adjust every dividend cycle. That's okay. That is okay. So with that being said, let's go take a look at Ford in my position. Now I did talk about right here, the compounding in the circle. Now we're going to look at that right now. So say you start with 100 shares of Ford. Ford trades between a range of about $14 is the historical average for Ford. So we're going to put the price in about $14. Right now Ford's at 11, I understand that, but I'm using the average range for Ford. So when we come back to this video a year from now and Ford's trading at 15, you can say, well, Jake, it was trading at 11, now it's trading at 15. What's going on here? We're just going to use the average price of 14. We start with 100 shares. Every month, remember we put that $50 away. We put that $100 away. That's the money we're paying out of pocket to buy more shares of Ford. Ford pays a dividend about 15 cents. And we have 100 shares, so that activates us to do covered calls. Remember, covered calls, you have to have the stock covered. For every one contract you sell, you need to have 100 shares of that company. So if we had 200 shares, we could sell 2 contracts. So with that just being said, we're throwing out just a little bit in Ford. And you might be saying, well, Jake, I don't have $1,400. The average U.S. household, the average U.S. American household receives more than $1,000 on its tax return every year. $1,400 is a little bit more than $120 a month. You can figure out how to do this. You can get to that 100. Remember, you can break it down. That's $116 a month. You can get there. For this example, we're just going to start with 100 because I have 100. I actually have 200 in my account, but we'll just make it easy at 100. So we buy $7 a month, 7 shares a month, pays a dividend. So in 10 years, what would this look like? Just by doing this simple math. In 10 years, we started with 100. At the end of the 10th year, we'd end with almost 2,000. Did we hit our goal of dividends of 200 and of our goal of hitting that 33,000? We didn't, but we're getting there. It takes a little bit of time. Now, what's really interesting about this is you can compound it in different ways. Say you wanted to build a portfolio with 1,000 shares of Ford, 1,000 shares of GE, and 1,000 shares of Apple. Well, once you get to this 1,000 shares of Ford, you can compound this to a different stock. Say you only wanted to get 200 shares of Ford, and once you got your 200 shares of Ford, you wanted to go somewhere else. Well, by the middle point of the first quarter of the second year, you would have hit your goal of 200 shares of Ford. And you can use this dividend and this covered call in Ford, and you can take this premium and go somewhere else. You can now take that Ford premium that you're making every month, and you can go look at a company like AT&T. You can go look at a company like TLT. You can look at, or that's the bonds. You can take this money and go somewhere else. And once you hit that goal, you can take that goal from that money and compound it somewhere else. You can use different streams of revenue to help compound another project that you have. 200 shares of Ford is not yielding a lot every month, but it is yielding something every quarter, and it is yielding something just a little bit with those covered calls. That $20 that you're making in covered calls every month, well, that's $20 you still have that you can put towards somewhere else. So say you want to look at AT&T. Well, you are making $20 every month from your covered calls. So 2 months of covered calls can buy you 1 share of AT&T if you so choose. You can use this to compound somewhere else if you like to. And here's all the math for this. Here's the month, here's the shares, here's your contracts, here's your dividend premium, here's your covered call premium. You can do spreads and naked puts on here if you wanted to. If you're a more advanced trader and you want to do more advanced trades, remember always research those trades before you get into. You have the ability on this sheet to do that as well. So say we take a company like Apple. That's trading at, I believe, $176 today. And say we start with 10 shares. And we're able to put away, realistically, we can buy 2 a month. Apple, I believe, pays a dividend now. It's a little bit higher than what we showed, of 73 cents. Answer that 1 second. 73 cents. We can't do covered calls on it, so 0, but maybe we were able to make $100 from selling spreads on it. We started with 10, but it wouldn't be until the 4th year that we'd have 100 shares of it, but we're still buying it with spreads that we're able to do on it. You can change the math to how you like it here. Maybe you want to sell some naked puts against it and you make $100 off naked puts. Will that change your pricing here? It will. It will change when you get into that another 100 shares. Just got to do that. So keep that in mind. You can change how you'd like this to look. I'll give this to you for free. You can give it to everyone in your family for free. So just keep that in mind. You can take the money that you're getting from spreads every month from Apple and you can put it towards buying more shares of Ford if you want to. If you want that where that money comes from every month, you could do that if you wanted to. So understand the power of compounding interest and what it can do for you in the future. Now it may be painful in the beginning, but over time it will greatly help you in this market. So remember that. Now there are a couple different stocks we're going to look at as well. I've broken down each one that we looked at today. We talked about ExxonMobil. We talked about Microsoft. And we talked about TLT. So we're going to look at those in one moment. How are we doing in time here? So I have a nice little PowerPoint for each one of those that I built inside the basket of stocks I was looking at, because I'd like to have that data for myself as well, and I'm going to give that data to you right now, and you'll have access to those PowerPoints as well. Remember, each one of those on this list here, I looked at the fundamentals, I looked at the technicals, and some of those I might have gotten a little bit wrong, but that's okay. I do have protection. I do have the ability to adjust it as well. So let's go over those right now, and I am going to turn the video off right now for all the people that are viewing this for free. If you want to look at all this premium content, join Wall Street IO. And I will have these up for you there.